In this section, we're discussing the decision maker's perspective regarding the choice of inventory methods. In the prior slides, we learned the choice of inventory methods or cost flow assumption will have impact on cost goods sold and ending balance of inventory. The cost flow assumption have impact on income statement and balance sheet. This is similar for depreciation methods we're going to introduce in the following chapters, and pension assumption, which you will learn in the next semester or in the ACT 512. Anyway, so the choice of different accounting methods is to meet a particular objective. Since the decision is being made by managers or human beings, so there's always conflict of interest. For the managers, they have the motivation to make the choice that could maximize their own benefits rather than the benefits of the owner, the shareholders, or external stakeholders. So that's the agent problem in the corporation. So this is the factor we should consider when we analyze a company, because the manager's decision will have impact on the accounting choice, finally have impact on the financial statements. Next, the factors influencing the method's choice. Because in this chapter, we focus on the choice of inventory cost flow. I didn't mention this term, physical flow. Physical flow actually is the movement of inventory during the company's operation, while cost flow is just an assumption. So cost flow may not reflect the physical flow, or cost flow may not align with the physical flow, because accounting standards allow the company to choose different methods. The methods chosen may not reflect the physical flow. And in reality, actually, FIFO align with the physical flow the best, because companies usually use their oldest inventory first, or sell their oldest inventory first. If the companies sell their goods from a mix of goods, so the average cost methods would more closely correspond to actual physical flow, while LIFO usually does not align with the physical flow. Next is the methods chosen have impact on the earnings and the tax. The company report the earnings in the income statement. It also report the tax reports to the IRS or state and local taxation authorities. So they prepared these reports to these government agents. The cost flow assumption have impact on both taxable income. This is a number reported in the tax reports. It also have impact on the income before tax. That's the intermediate components in the income statements. The choice of the cost flow assumption has impact on both reports. And taxable income will have impact on the actual cash tax paid. And this will have impact on the tax expense. And finally, have impact on net income. Remember this example. If the cost of inventory keep increasing, a LIFO will result in greater expense. In other words, it will result in less taxable income and income before tax. So if this is the case, when inventory cost rise or and inventory quantity are not decreasing, then LIFO will produce a lower net income and lower taxable income. So companies use LIFO, usually they have the motivation to reduce their taxable income so they can pay less tax. But this does not reduce the tax liabilities permanently. It's just deferred, which is topic you will learn in the next semester. Many companies choose LIFO with the purpose to reduce their current tax payments or defer the tax payments to the government agents. And the IRS requires companies to follow the LIFO conformity rules. That means if the company uses LIFO to reduce their taxable income or cash tax, they must also use LIFO for their financial reports. So use the same cost flow assumption for both reports. So that's the conformity rule. There are many different factors that have impact on the choice of accounting methods. We should know these factors and also understand the motivation behind these factors, whether they improve the quality of financial statements or reduce the quality of financial statements.